It's my pleasure to welcome to the stage two people today. First is Fraser Kinsley, co-founder and managing partner at Kinsley Partners, an early-stage VC fund, as well as Jack Ambrose, co-founder of Jambies, which brands itself as an inactive wear brand. So let's give a warm welcome to Fraser and Jack.
It's pretty athletic.
For sure, guy.
Oh, man. Well, thanks everyone for joining us, and thanks for the introduction. I'm Fraser Kinsley. As mentioned, I'm the co-founder and managing partner at Kinsley Partners. Kind of a cool moment for me personally. I hope for Jack as well. Jambies was actually one of our first investments way back when, and been really cool to, I think, follow their growth journey. And so I'm really excited to, I think, explore this conversation. It's a conversation that we've had a lot, and I think to share a lot of really what's changed. Call it since 2018, which I would say was the golden era of direct-to-consumer and e-commerce fundraisers. And so really excited to have Jack joining me. So Jack, I don't know if you want to introduce yourself really quick and share a little about the Jambies story, and then we can hop right into it.
Yeah, sounds good. Thanks, Fraser. Hey, everyone. I'm Jack. I'm one of the co-founders of Jambies. As was said, we make performance and activewear. We launched end of 2019, so right before COVID. And so now we're getting in our third year here, and it's definitely been a whirlwind, but really exciting.
Awesome. So Jack, I think really, and I think everyone kind of resonate with this a little bit. E-commerce has obviously changed a ton since even before COVID, but really in the middle of COVID too. I think there was a lot that changed really on the fly. And for you guys specifically, how would you say that things have changed drastically in the e-commerce landscape as a whole?
Yeah, so actually, I'll give just kind of a quick background on how we started, because we launched 2019, so I had no idea. We had no idea what was going to happen with the world. So, before 2019, I had no apparel experience at all. I was actually in commercial real estate, and I helped WeWork start their real estate investment arm. So I have enough Adam Newman stories that probably could take the rest of this time and probably would be more exciting. But for me, it was just let's make 1,000 boxer with pockets. I've been talking about this idea my whole life, and success for me was the day I quit WeWork to make 1,000 pairs. And I had no grand vision for Jambies at all. It was just, I talked about this idea of boxer with pockets since I was 10 years old. I told 10,000 people about it, and I didn't want to be someone that talked about doing something their whole life and never did it. So that all happened the summer of 2019. Me and my co-founder flew out to Los Angeles. We somehow made 1,000 boxer with pockets. We launched October 1st, sold out of all 1,000 boxer with pockets the first day we launched, and everyone started calling us, and they were like, when I get home from work or I get home from school, I switch out of my work clothes and I put my Jambies on, and it's Jambies time. And we're like, oh shit, okay, that's what we're building this company around, right? And what was kind of crazy is, there were so many crazy things on the production at first. We wanted to be all American made. We started in Los Angeles doing everything. We got lied about the pricing. They lied about us when they were going to finish it. The quality wasn't as good. So we moved everything down to Mexico for Christmas 2019. They somehow make a couple thousand pairs for us. I'm illegally smuggling stuff across the border from Mexico into San Diego to ship to people to get to them before Christmas. And then the week after, the factory calls me. It was a husband and wife, and they filed divorce against each other, and they threw all the Jambies in the street in Mexico. And then I moved down to Ensenada, Mexico, which actually was really pretty, and I finally found the Hurley person that made all Hurley stuff. They get running with Jambies, and then COVID hits us. Factory shuts down for 6 months. So I just like telling that because I don't know what was normal before COVID either, And for us, the crazy thing was COVID happened, and CPAs on Facebook for us went from $50 to $10, but we had no inventory, So it was kind of this chicken and egg problem. But what happened was we slowly got inventory back online. And the difference between 2020 and now is like, I mean, we literally, you couldn't mess up back then. It was crazy. It really was like the gold rush, especially with like the stimulus checks and everything, is like people were buying stuff right away. And how, now I'm just talking about like from an acquisition standpoint. I bet that's the biggest thing that has changed because of iOS 14. So now we really have to focus on every acquisition individually. But did that really answer your question?
Yeah, no, I had no idea about the legal smuggling for the record.
Yeah.
So, but no, I think so a lot of what we do at Kinsley Partners with the rest of our brands as well is advise on the operational aspects too. And I think really that sentiment that you shared is I think what's been shared across a lot of our brands, and it's actually a really good segue I think to this next piece that I want to talk about, which is really the crux of the discussion, which is kind of finding that happy medium between growth mode as an early stage brand, right, which is really what everyone's looking for. But also your costs, right? Like this is not, we always say this is not technology, this isn't SaaS. Like there are assets and fixed costs behind a lot of these products, or all of these products, I should say. And so again, like kind of juxtaposing, call it that era of 2019 through like early 2021 to now, rising interest rate environment, all the new iOS updates. Supply chain looks a little bit better. The Port of Long Beach isn't clogged up anymore. And so things have significantly changed. So I'd say from our standpoint, we're seeing this across the board, from apparel all the way down to food and beverage. But specifically in apparel, what would you say are some of the areas that you're focused on with growth this year, whether that's, customer growth or SKU catalog growth? If you could just walk me through that a little bit.
Yeah, I think the biggest thing, me and my co-founder learned last year was growth and making sure you're in stock of your best-selling products. It kind of, we talked about calling jambies an activewear, and that is kind of like our whole shtick is like, you spend more time sitting on the couch than you do working out. So like, it should be fun and you should celebrate chilling. So if you go on our website, it's a lot of fun stuff like cheetah prints, which like I never thought would sell well, but sells really well. And like all this fun stuff. And that's what works for acquisition. But when people click on that ad, they go on the website and they just buy black or gray. So that was kind of like a lesson we learned last year is like overstocking in our core products because those are our best sellers. So just doing that with growth. The thing that's crazy is, if I was starting over again, I would do something that had on-time manufacturing because I think inventory planning and growth is like by far the hardest thing we had to do because the day we order jambies from our factory in Asia, it takes at least 4 to 5 months to get that product in our fulfillment center, right? So like this fourth quarter, we did way better than we thought we were going to do. So we just learned that we were going to do better than we thought we were going to do in December. So we placed that 4 to 5 month purchase order in Asia, and then all of Asia shuts down in February for Chinese New Year, So I think that's been the toughest thing is, and going back to that, is figuring out how much do you want to grow this year and how much inventory do you need for that growth? Because last year, the whole point for us was we did not want to overbuy inventory and be stuck with inventory and have a cash flow problem, but we got the reverse of the problem. So I think the number one thing for managing growth for us, honestly for us, it's like, how can we not double this year? Like, how can we just grow 50%, but actually hit that 50% that we want to grow? Because a lot of these companies, you double each year and capital fixes a lot of these problems. And for us, it's like, if we grow less, but we do all those small things like ordering our best products and making sure we have them, we can grow a lot more profitably than we would have in the past.
Yeah, definitely. And I think, one thing you and I were speaking about right before this is there's just been this big push for more omni-channel development. So I think there was a lot of brands, obviously, that came out again, call from 2018, even through now, that were strictly e-commerce focused. And I wouldn't even say direct-to-consumer focused, but, e-commerce / digital. And so I think with this push to omni-channel, it used to be a big focus on income statement, basically how much money are you making, but with different cash flow terms and remittance terms, this concept of cash flows coming back. And so what do you look like as a cash flowing business is something for us that's become extremely important when we're looking to evaluate brands now, especially in this environment, because again, really those days of cheap money or even free money are kind of going away. And so a lot of the conversations of, again, managing this growth is not just can you get products out to customers, but can you maintain a cash flowing business? Again, in one that's very capital intensive because it's asset based. And so a lot of what we've been doing is managing costs in a way of a cost to serve methodology as opposed to cost of goods sold. And what I mean by that is taking the full picture of things like ad spend, things like fulfillment costs, freight and parcel cost, blending all those together and looking at the aggregate cost to serve. And so what I'd ask you, Jack, is as a brand owner, thinking about how there was a bifurcation previously of ad spend versus called inventory spend. Are you looking at those things more tightly now as far as the relationship goes, or are you still keeping those separate?
Yeah, well, I think the first thing that we started doing last year was looking at ad spend by product. So it's like, this hoodie, how much does it cost to acquire a customer just with this hoodie ad versus our main product, the boxer with pockets? And even if the CPA is higher on this hoodie, if the margin from that order is still higher, then we have more room to play with and we should buy more inventory in this hoodie. So I'm trying to think what would be helpful. The best way we're doing this year is in the past, like in those first 2 years of COVID, it was just like, let's get as much inventory as possible. Let's spend as much on Facebook as possible. And then let's just keep pushing like whatever expenses we have down the road by keep buying inventory and keep doing Facebook. Now this year, it's like, there's a certain amount of return we would get if we spent $3 million on Facebook this year. There's a certain return we'd get if we spent $2 million, and there's a certain return if we'd spent $1 million. And we're a lot more confident with if we only spend $1 million on Facebook, we could get $3 million back from that $1 million. Then we're confident that if we spend $3 million, we can get $6 million back, right? But that's kind of a tougher thing to tell an investor is like, oh, we're only going to do $3 million through Facebook versus $6 million. But what we're trying to do now is let's have higher predictability. So then if we were gonna plan to spend that $3 million to do $6 million in revenue, we'd have to buy inventory for that $6 million. And if we don't get 2-to-1 ad spend, revenue to ad spend, then the whole business is screwed. So kind of like what we've been doing is like, let's forget what other people think about and what can we 100% predict? If we only spend this amount, we know we can get this amount of revenue on it and then plan inventory after it. And kind of one of the things that we lucked out with is the Fabletics founders are one of our largest investors. So they connected us to their factory that we now use for our cut and sew. So everything I just talked about, the biggest unlock now is we don't have to place deposits down with our factory. So kind of what I was just talking about, if we're going to buy $3 million in inventory, $3 million retail value, that's at least $1 million of inventory that I have to buy before people purchase it. In the past, we'd have to put 30 to 50% deposit 4 to 5 months before we order that. So now that like deposit issue goes out the window. So now I can do stuff where I'm ordering 3 million retail value of goods. What I'm doing is I'm ordering 6 million, but I'm telling the factory I want it over 3 months, right? And I don't have to put that deposit up front. So this way, I'm almost using the factory as my lender because they're finishing all $6 million of goods up front because they're trying to get economies of scale to make money off of us. But I don't have to actually pay for those goods until I bring them over. So I can see how that first $1 million of Facebook spend goes. And if it's going really well, the product's already made, and then I can bring that stuff over. And I think that's actually kind of one of the blessings with apparel too, is because our product, it's decently lightweight compared to what it costs to air freight, that it still makes sense to be able to do all that.
For sure. And, it's this is kind of an area I think on the fundraising side that we've kind of delved into more is, and it was actually a good segue kind of talking about that, is kind of like these alternative, for lack of a better term, call it like lending or cash sources. And, I think from an investing perspective, right? Like I've always said that we keep it very simple, and we have to look at what are our returns compared to the market. I'm not a built-out venture capital fund. I don't have public investors as LPs, and so for us, it's a very binary question of will this brand generate venture returns for us, or am I better off putting my money in the public market? And now. Really, a lot of what we've seen, again, over the past 2 to 3 years is this concept of brands raising on safe notes, which obviously don't carry an interest rate behind it. And so what that does, and again, a rising rate environment, is it's forced brands to chase different funding avenues, per se, which then goes into things like PO finance and inventory financing. So you kind of have this shift where it's actually less beneficial for the VC or whoever the angel is to actually make that investment because of the fact that the competition to give that cash is a lender who's making 30 to 35%. And so I think that concept of what you kind of just spoke about of like these key unlocks is what we've seen a lot of our brands do. Well, again, alternative funding sources such as PO financing, inventory financing, which again, carry their own risk with them. But I think the other side of kind of what you mentioned too is really achieving this economies of scale. And I think from that angle, a lot of what we've seen is this idea of outsourced manufacturing, but also insourcing things. And so from your perspective, are there areas where you're like, hey, actually, the economies of scale we were looking for outsourcing aren't really there, but like we brought stuff in-house, that's been a massive blessing for us?
Yeah, so kind of the team of Jambies, it's still only me and my co-founders, the 2 full-time employees. But the whole thing, kind of when I was talking about running around and getting Jambies made, kind of when COVID hit, our thing was like, all right, let's stop like playing around. Let's go find the best people in the world that know how to make product, right? So that's kind of been my superpower. So the first person we found was the guy who ran fabric innovation at Lululemon. And another thing there too, if anyone wants to like start a brand, like it was a lot easier having that conversation with him after I was, running around like a crazy person in Los Angeles and Mexico and had product that already sold. Cause like a guy like that, he gets people coming to him every day with like, oh, I want to start this thing. And it wasn't like, I want to start this thing. It's like, I'm in this thing, And kind of the pitch there always from the beginning was like, do we hire a B or C player and pay them $100,000 a year? Or do we go after the A player? And like, that's kind of what we did with the Lululemon fabric innovation guy. I was like, I will literally pay you 10 grand a month. You only have to work for us 2 days a month, but like bring me to Lululemon's fabric mill and bring me to Lululemon's factory. And that was kind of like the philosophy in the beginning. It was like, if we can get the best product, then everything else would kind of take care of itself. And I think that's what we thought we learned differently than a lot of like the DTC darlings that we all know about that like aren't doing too well now is like, we're like, if we can get the product right first, like everything else will kind of take care of itself. So that was the one thing where like, we're going to spend all of our money on building the production team. So our team right now, it's just me and my co-founder in the US, and then we have 7 people on the production team around the world. We have 2 designers that did all Roger Federer stuff at Nike Tennis in Scotland. We have a designer that like did all the Man City and Barcelona jerseys for Nike in Amsterdam. We have the fabric innovation guy in New Zealand, 2 ex-Lululemon employees in Taiwan. And we're like, if we're going to build an apparel brand, apparel, like it's very hard to patent your product. So like you have to make sure people love it when the first time they touch it or the first time they wash it. And I think, that's what Lululemon did is they focused on product first. So that is the whole entire Jambies team. Then the lucky thing is me and my co-founder are very yin and yang. He's all marketing, right? Like he was a writer photographer at GQ magazine. He's the one that came up with performance and activewear, work hard, lay hard. We're building clothing for the 5 to 9, all those things. So he's doing everything on the customer acquisition. I'm doing everything else besides that. And my whole entire job is to make sure he doesn't have other stuff on his plate because we don't have a company if he doesn't acquire customers. So with that philosophy, him on the marketing side, it has been a lot because it's really tough to build a brand and do performance marketing well at the same time, especially if that person's a brand-focused person. Because we would all look at Facebook ads and we'd be like, oh, that's the best ad. And then you throw it in Facebook and it performs the worst. It's a really weird thing. But now what we've done is like had him more focused on the brand side. And we have an outsourced agency that does all our marketing and everything, which is kind of nice to have. I know there's the whole push of like, you should have all marketing in-house. What we try to do is we try to make all our creative in-house. So in our office in New York, me and my co-founder built a fake living room in our office and like painted the walls lavender. But like the only way to win at Facebook is to keep having new creative all the time and then keep doing that creative with different products or trying to build on the creative. So we try to own the creative and then we give it to an agency to run all our ads. Because it is nice thing about an agency is that agency's running 5 other brands. So they know it's like, oh, your ads suck or like Facebook just sucks this week. So that's been good. I think also we definitely need more people. I mean, we're definitely at the breaking point. It's kind of tough, though, when like you start a brand in the beginning and you want to micromanage everything. And now it's like, I shouldn't be doing supply chain, fundraising, finance, production all at the same time. But it's always tough to take that first step to bring someone in as a full-time hire when you think you can do it. So I think we are kind of getting to that breaking point. And then just the last thing to add, we have 3 employees in the Philippines. Me and my co-founder both have an assistant in the Philippines, and we have our inventory planner in the Philippines, and like they are the hardest working people ever. It's really crazy. And like we pay them, I mean, we probably pay them like 30 to 40K annual salaries, which is a lot of money in the Philippines, but like it is amazing how hard these people work. And also it's kind of sick. Like I go to bed at 8 p.m. and they're waking up and it's 8 a.m. and then I tell them tasks to do, and then I wake up at 8 a.m. and their work day's over and all the tasks are done. So you're kind of like doubling. It's kind of tough too, because like it just depends the kind of task you want that person to do, but it's been crazy.
Yeah, definitely. And I think, it's gone beyond, I think, just general tasks. And I think, from a call it historical standpoint, the agency aspect of a lot of the work that's been done, especially for digitally native brands, has really been on the marketing side. But a lot of what we're seeing now is, I think, again, you saw an explosion of, I think, 3PL growth in, again, 2019 and 2020. All of the ships.
We used an outsourced 3PL too. So
exactly, and I think it's gone even beyond that. Again, we see one of the sponsors here, First Mile. I would consider them an outsourced service provider for a more specific niche, just beyond the catch-all of third-party logistics. And so, a key component for us operationally when we're evaluating a brand is, what is their overhead and what are their fixed costs? Because again, I think that we're always thinking about. And this is just, again, I think from a prudency perspective of, okay, what's behind that like really nice ray of sunshine, which again, I think was like these past couple of years. And it's like, yeah, fixed costs are really scary. And so, for us, I would say this is probably across the board, we've been seeing a massive uptick in 1 or 2, founder teams that are doing, 8 and 9 figures. And most of their operations, most of their marketing, most of their branding, most of their site development, storefront development, even Amazon work is done by outsourced agencies. And so it's again, I think that for us as investors, that's actually a huge upside. And I think in the past, it's been what processes can you own internally? But now it's what processes can still run without you owning them internally. And so again, I think that component of dialing in the areas that you can outsource without breaking your model is probably, I think, the biggest exercise we've been doing basically in the past 18 months. And so I think kind of with that in mind, he talked a little bit about kind of service providers there, specifically on like the third-party logistics front. How are you guys evaluating service providers, whether that's, technology to monitor fulfillment times or shipping costs or, platforms like a Flexport? Like, how are you looking at things beyond just, marketing and brand agencies?
Not smartly, first off. Mostly just messing shit up and then like trying something else. I'm trying to think which one to go first. Like how we found, our 3PL, like this is our third 3PL. That's where we're like, what can we do that doesn't break the business that we can switch quickly? And then we just like tackle it from there. Trying to think what would be helpful.
Fail and fail fast.
Yeah, exactly. It's definitely hurt us sometimes though.
Walk me through kind of the fulfillment aspect, because again, as an apparel brand, you're subject, especially from where production is subject to pretty high tariffs coming from China specifically. And so when you think about things like fulfillment and again just your cost to get product here, never mind ship it out.
Yeah.
How are you looking at that versus again call it 2 years ago?
Yeah. Okay. Cool. So at least everyone can learn something today, because when I learned this, I thought it was illegal. So when we bring our products in from China, that's why I wanted to do in the U.S. first, right? Like I don't want to pay. I want like tariffs from China or Asia in general to the U.S. are like 30 to 40% of the product usually. So like if we sell our boxer pockets for $35, we make it for about $10, but really it costs about $14 to $15 total if you bring it in from China, right? So we're trying to figure out like, can we make it in the US for $10, but it will be the same quality? Then, when I was in Mexico, what I learned is when you order Bombas socks, it says it's shipping from San Diego, but they're actually pick and packing it in Tijuana, Mexico, driving across the border and shipping it from San Diego. The reason they're doing that is because Obama in his second term passed something called Section 321. And what Section 321 is when you're at the duty-free airport, like when you're in Mexico City and you fly back to the U.S. and you know that duty-free airport, you as an American can bring $800 of goods back into the U.S. tariff-free each day. And what they didn't realize is that also faded into e-commerce. So when you order Bombas socks, they bring it from China to Los Angeles. They have a special broker pick it up so it never legally touches foot in America. They bring it to Tijuana. They pick and pack everything. And if your order is under $800, they don't have to pay that 35 to 40% Chinese tariff. But if when we ship to Amazon and it's a $50,000 order, it goes through customs and we pay all customs. So it's only like one customer has to spend under $800. So because of that, I mean, that was like why we moved fulfillment centers is like, it saves us hundreds of thousands of dollars a year, which is like insane to not take advantage of. So we get to I'd say like 60 to 70% of our orders, we don't have to pay the Chinese duties or tariffs. The other ones, if it's $1,000 order, we're still making money. So it's like, doesn't really matter. But that's one of the main reasons why we're still, doing production in China and shipment from Mexico.
Definitely. And I think, since I've kind of started in this industry till now, the amount of tech offerings out there and platforms and, again, very niche services that are out there has probably 10x'd. And so from like a tech stack perspective, I know this is like a really popular question, and there's no right answer in my opinion, but, from your perspective, again, as in your words, an inexperienced operator moving into this space till now, what are some of the pieces of the tech stack? Not from like hey, I think this is great because of what it does, but if you're paying for something, it's going to affect your margins. And so from your perspective, what would you say are very core pieces of your tech stack that what you would say are pretty tantamount to Jambi's success?
Like supply chain oriented or like?
Anything, marketing, supply chain.
Good question. Shopify, number one, we do everything through Shopify. First and foremost, that's made it super easy, especially just being like a direct-to-consumer company through our website. So Shopify, number one. We use Klaviyo for email, PostScript for SMS, Happy Returns for returns. And then, we do most of our acquisition through Facebook and Instagram. So those are kind of like top of my head, but that's not my expertise. My co-founder does a lot of that, so.
No, it's all good. And then for brand, and that the kind of lead into that question was for brands that are starting out, that are looking to not just go the Shopify route, but want to also explore Amazon off the bat. You obviously started out, again, straight e-commerce, straight, what I would consider like a true direct-to-consumer model, going into Amazon and kind of doing that sequentially. What would you recommend to a brand that might be used to their direct-to-consumer margins moving into Amazon? Like, what are some of the things that you're like, wow, I wish I knew that before I went onto Amazon?
Yeah, so we just launched on Amazon in November, and the main reason we did it was pretty much as like a defense mechanism because we're spending so much money each year on Facebook and Instagram ads, and I don't know the numbers, but like a certain amount of people are seeing those Instagram and Facebook ads, and they go to Amazon first to see if it's a real brand. So then we started getting like the numbers from Amazon that 20,000 people a month were searching Jambies on Amazon, and there was no Jambies on Amazon. So for us, it was just like, okay, how can we do it as a defense mechanism? And the boxer with pockets, as we said, is our core product. So we were like, okay, and it's probably like 30% of our revenue. And we were like, okay, let's just put those on there, and let's just put it in our core colors. So that was like the philosophy of doing it to start with. And it's kind of tough. The Jambies math is like, our average order value is about $100. After you take out all product costs, shipping, returns, everything, we make about $50 every order, but that doesn't include customer acquisition costs, right? Then you go to the Amazon model. The average order on Amazon is only like $40 for us because people just want to buy the one box with pockets, and then Amazon's taking about 35% of that $40, and that includes, I think it's like their 17.5% Amazon FBA fee, and then they're taking like 17% shipping or whatever. So for us, we're just like, that is still a profitable, or if you're pretending that all the money we're spending on Facebook and Instagram is only going to our website, then those are still profitable orders. And if those people ever want to buy other products besides the box with pockets, they have to come to our website. So I guess that's really the extent to what I know about Amazon right now. another thing about Amazon that, I'm not used to with Shopify, like Shopify distributes your cash every single day or 5 days a week. They don't do it on the weekends. Like Amazon, like we have $10,000 of cash sitting there right now from sales like the past week. And Amazon like only lets you distribute $500 of it. Cause they're always like, oh, we need this deposit and this and this. So it's like, that's been the biggest thing going from like direct consumer to Amazon is Amazon, we're shipping them all those boxers with pockets, and then it's taking them about 4 months to sell it. And then you're always like, why? Like, we've sold it. Why haven't we gotten all the cash yet? And they just have all the power, I guess.
I'd say so.
Yeah.
So kind of moving kind of into, and this is I think the piece I want to touch on a little bit is this idea of, I think, fundraising, right? So I think it's safe to say I think the environment's changed significantly over the past 12 months. I'd say even 6 months. And so from our perspective, I think there's certain things that we're looking at in brands. But from your perspective, obviously, you're talking to other investors or, have other investors on the cap table. I'll share a little bit from our side. I think what's important to us, but from your perspective, what are the things that you're wanting to highlight to, potential investors or, investors that would re-up?
Yeah. I mean, I could talk for like an hour about this. Fundraising sucks. It really is like the hardest thing ever. But it's good because it makes you really have to craft your story, which is definitely really helpful. And then that kind of like brings it into, a circle and talk about your brand. Kind of for us, I mean, we just didn't know what we were doing. Also, like, we didn't know that we actually were going to really like building this brand. Like, if I was doing it all over again, I would have never raised outside money. But I didn't know you could not take advantage, but I didn't know you could work with manufacturers and try to get better payment terms or, and also, I would have just gone way slower. Because, like, I think what we're seeing now with a lot of the direct-to-consumer darlings, like Allbirds like shot up so fast that they never had time to actually like build a customer base or like find out what products their customers actually wanted, and then it just goes right back down. And I think like if you look at all the brands we know now, like Lululemon took like 20 years for like people to even know what Lululemon was. So that's kind of like my first thought on it. And then the second thing that could be helpful if people do want to fundraise is like fundraising. I mean, one, it just stinks fundraising from family and friends. It's like you're asking the people that you really know, like for money. It's just like not a fun experience. But I didn't know any other investors, and it's not the easiest to fundraise in direct-to-consumer and apparel. So like we got so many no's, and then we got the Fabletics founders to commit to our round, and then everyone wired money the next day. So like my only advice would be like, I should have just spent all my time trying to find like that brand name person or that brand name firm, because it's so much easier to round up the rest of the people, especially people that don't know about apparel. Then they were like, oh, the Fabletics founders are investing. Like, they must know something because they know the space. Like, wired the next day. So it's like the two things.
Yeah, and I think, from our perspective, that it's tough to, I think, strike that balance. Where we kind of fit in, or on the spectrum, I should say, of, round raises, we're pretty early stage. And so a lot of it's like, hey, there is no barometer to kind of measure this up against. But, a lot of times, we're really not engaged with pre-revenue, brands, but, they're low revenue brands. And so, really, I think a lot of what we're looking for now, again, compared to, I think, years ago, which was just, hey, show me your income statement and how much money you're making is, again, things like cost to serve, things like contribution margin, things like cash flow. And really, I think this idea of balancing brand with just healthy fundamentals operationally is, again, something I just keep hammering home. And it's a really boring point, I think, to talk about. And it's usually a half of a slide on a pitch deck. But those are kind of the key components, I think, really, that we'll see over the next, again, year to 18 months. That's going to prove out the brands that are really worth something, the ones that aren't. And I think you touched on a little bit, too, with, brands like Allbirds, again, some of these DTC darlings, is in fundraising environments that were very friendly to folks looking for funds, those valuations go sky high. But there's a crack of that bullwhip on the other side where if you're not supporting that valuation in your revenue, you're going to need cash eventually again, which means another round raise, which means that you're potentially looking at a valuation cut, which is probably the last place you want to be in when you're raising money. And so I really like what you said about the, kind of doing it slowly and methodically. is, again, a lot of what we suggest as well. I mean, I think I don't know if anybody else says this as an investor, but there's been plenty of times where I've recommended, hey, I don't think this is the right time for you to look for funding. Same thing on third-party logistics. I don't think it's the right time for you to outsource. Same thing for, branding. If you're going to immediately hire a branding agency to run the entire process, I don't think that that's something that you necessarily own. And so again, I think these kind of fundamentals run across the board, not only when looking at the brand from an investment perspective, but just from an overall health perspective. And then, again, talking about brand stories, I think one like yours, and I'd say that most of the brands in our portfolio share not the exact same story, but a similar story where you're proving out a lot of the concepts that you were, where you're at now very early on and being very scrappy with it. And it's not like, hey, prove to me how, devoted you are to this. It's like, do you actually know the products? Because quite frankly, like, I don't want to learn a lot of the mistakes with you. Like, I'm here as a support mechanism for you, but I want to know that you did some work up front to at least prove this thing out. Because again, if it's very easy to turn on a product, whether it's from Alibaba or a contract manufacturer here in the States, and it's just, hey, we're going to white label or private label this thing, to me, A, there's not a ton of brand value there, but B, it's not really a resilient product in and of itself because, again, it's, we talk about things like coffee. And if you have a coffee brand, no offense to you, but it's, we've had a lot of these where it's like, hey, we're a coffee brand and, we're private label out of, Texas. But there's 50 other brands that have those same exact beans, just a nice package that's a little bit different than yours. And so for us, again, I think on the fundraise side, it's gone back to this idea of fundamentals. And really, I think where direct-to-consumer started and where digital native brands started, which was owning the manufacturing process, owning the distribution process and the rights, and then owning kind of your customers, really. And so I think a lot of that, and again, I think you highlighted that, which is dialing in those things early on makes that process way easier on the back end. And so from your perspective, kind of where you're at now versus when you started, if you were, young Jack starting Jambies again, like what would you do differently in those first, call it 6 months, really across the board, whether it's operationally or from a marketing or customer acquisition perspective?
I think, I probably we probably should have taken more time to perfect the product in the beginning, but it's kind of tough because it's like, we didn't, and we just kind of built and then got customer feedback, but we're on version 7 of like the box with pockets, and they're like way better than the first version. So maybe I probably would have taken more time, really perfecting the product before we launched. And then we should have chomped up. We kept going bigger each time just because that's like what we do. But like we really should have gone smaller. Like we really didn't need to buy twice as much inventory just in case we ran out. Like we should have gone small 1,000 order, then 2,000 order, not like 1,000 order, then 10,000 order, and then try to keep going bigger each time. So I would have gone slower, but we didn't know what was going to come in front of us. And then besides that, I mean, I'm really lucky that me and my co-founder kind of like we went to college together, but we weren't friends in college. And I'm really lucky that we're very different. I think that's like the only thing that's really made us survive is we don't work on the same stuff and we trust each other a lot, and that helps it go.
Awesome. So I think we've got about 5 minutes left here. I did want to take an opportunity, I think, to have a short Q&A session. So I'm not sure if the Pattern folks have microphones, but happy to.
You guys, we could probably hear you.
We could probably hear it if you want to just shout it out.
So I got 2. So the first one is, can you go into specifics of how you were finding the vendors in Mexico and like how you were sourcing them, the list, people, how are you reaching out, just door knocking, and how do you go about the Spanish? I would love to do that. And the second part is like, how do you decide like that co-founder was the right co-founder and like the right person to go into business?
Yeah. So the first one, you mean like when we were making the Jambies, or like now when we fulfill out of?
I would say both, because right now we're looking to get some vendors down in Colombia.
Yeah.
So I'm kind of like step 1 right now.
I know, it's so tough. How did we even find the Mexico? Trying to think. I mean, it all started like, well, I just know apparel. Like, so like, it was just calling the people I knew. Like I had one friend that had a t-shirt brand. So then I just started calling him all the time. And then he was like, you have to find the fabric first, right? You find the fabric and then you can start moving from there. And then like another person told me like, you need to find a sample maker. So then she gave me her friend Gustavo in the garment district in New York. Then I just started going, so it's just like step by step. The best thing to do is like Patagonia is like our North Star company. Patagonia posts online every single factory they work with. So like if there's probably someone in your industry, and then if you really want to get like interesting with it, every company, if they import stuff from outside the country, there's like Import Genius or one of those websites.
I was gonna say, yeah, Import Yeti.
Yeah, like I just type in like Lululemon like China imports, and then you can back into like what factories are using in China, And that's just apparel, but I'm guessing you do that with other ones. And then exactly, it's like that was one of the things that was different. Like when we first started working with China, they didn't want to work with us because all the big players weren't paying them on time because of COVID. So it's just being a good person. You have to pay up front sometimes. You should go and meet them in person. And then the co-founder thing, dude, I had no idea. It was like, probably should have thought about it way more. I just really wanted to start this Boxer with Pockets company. We had another friend from college that started a company. So then I just started hanging out with him. And he's like, dude, I told Global about your idea. He thinks Boxer with Pockets are awesome. So you should meet with him. And then we had one meeting. He was the only other person that thought Boxer with Pockets was a good idea. And then we went off. So probably wasn't smart, but you got to have someone that believes in it just as much as you.
Yeah, go ahead.
Hi. One of my questions had been, it was really awesome to hear from investor side what kind of earmarks that you were looking for in the business to be like, hey, these are the pieces that I want to know about. From the other side, one of the fears that I have as a business owner is having someone invest or partner who then starts kind of turning the steering wheel way hard left than what I had envisioned.
Yeah.
And that it kind of holds my business hostage in some ways. What is your approach, or how do you vet people to partner with, or how do you vet people who want to invest in you?
Yeah, it's funny because like the person that sends $1,000 check like asks 2 million questions more than the person that sends $250,000 checks. And look, I didn't have the option. We just needed money. I didn't care who gave it to me. Like I wish we spent more time. Luckily, we haven't had any problems. Another thing though is like we haven't raised the price round yet. I don't know how much everyone knows about Safe Notes, but we've just raised on Safe Notes, so it still gives me and co-founder like all our control. Like, but we know when we do the price round, it's not. First off, it's not our company anymore. Like, I have other people's money in this company. Like, I work for someone now. And that's like definitely when you take money, that's the first thing. So unfortunately, I haven't dealt with that. I think they know how passionate we are about what we're doing. Because that's the thing. Every investor, they're like, oh, have you tried this? Have you tried that? I'm like, dude, I don't sleep at night. I think about this company 24/7. Like, yes, I've thought about it, but I don't want to say that to them, so I don't. So I haven't had to deal with that, but I think if you have to know your vision stronger than anyone, right? Like, I think that's the thing. Like, we knew what we wanted to build, and that's the vision I pitched. We've gone different ways to get there, but like what we're building, still the same thing. But yeah, we didn't have the pleasure of like picking our investors, so it could happen. Hopefully it doesn't.
I do think I can answer some of that too. Like I would ask. I mean, I think as investors, I try not to be too blunt, but I think most investors are super blunt about asking you questions as brand owners, and you're equally in your right to ask the same questions of how do you operate with the brands that you invested in. What is your expectation as far as input? Things like that I think are all pertinent questions, and I think, quite frankly, if the investor is uncomfortable answering that question, that's probably the answer to your question. And then depending on how they answer it, I think would be informative to that. I mean, I hope this is the case. We get an update from you guys and hey, great work. Let us know if we can help with anything. And so it's going to be really dependent on that investor. But again, I think it doesn't hurt to ask, really.
Oh, and another way to combat it is like, I mean, everyone is really nice. And when people ask questions, it's good because it makes you do the work. But like, I'm usually I just call the person, because like people are a lot less mean when they're on the phone or like, versus like an email.
Jack, so you touched upon profitable growth as well. Do you have a real-time view of the profitability, be it by product or by channel or certain initiative that you're taking? And if you do, if you have to push up profitability, what do you think are two most important levers, be it pricing, promotion, inventory?
Yeah, I mean, it's like we should have thought this way faster. You know, it's just like we were drunk on this on like where the world was. Like we spent so much stupid money the first quarter last year because we're like, oh, we did we did like $3.5 million in revenue in 2020 and like $2 million in the fourth quarter, and we're like, oh, if we get to 10 million in revenue, we could raise at 3 times higher value. You know, it's like so dumb. So now it's all focused on profitability, and that's where the best thing, honestly, has been focusing on product, because now 50% of our revenue is returning customers. So when we talk about CPA and stuff, it's like we could shut off all our ads and still do a couple $100,000 in revenue this month, right? Then it's just like, are you covering all your product costs and everything, and are you covering your salaries? So that's the most important thing, but probably is talked least in profitability, right? And I think, look, it's tough. I mean, there is that. It's tough for us too, because 50% of our business in the fourth quarter, and if you don't acquire someone now, they won't try the product. And like our best customers are people that try a product now, and then they buy 5 products as gift for people in the fourth quarter. So it's a very fuzzy line. I think for us, it was just like, what if we spend $100K in Facebook next month, do we know what revenue we can get back? Looking at cohort data, do we know what returning revenue we can get next month? Can we throw in a flash sale if we have to because of where the world's at? And with that, do we have enough money to pay all our G&A, and is there anything left over? So that's kind of how we've been looking at it. Yeah.
Sorry, what's G&A?
Oh, like general, I don't even know, general and administrative, but like that's all our salaries. That's all our salaries. Like I say like gross margin, everything above is like our product costs, fulfillment costs, then a marketing, then G&A's like our office rent, our employees, and like all the other random expenses we probably pay, software.
Forgive me, a lot of anagrams this week. So.
That's okay. It says 0. Does anyone else have a question, or
I think we're getting kicked out. No, I'm kidding.
can we answer one last one? Okay. Yeah, I was so dumb. I easily could have kept my job and kept getting paid. But I'm just like, I'm just so 0 100. And I think also people took me a lot more serious. I don't know if that meant it helped or not, but like the sample maker took me a lot more serious when I was like, I could come anytime, you tell me. And that's why, like 1,000 sounds like a lot, but I was like, I've talked about this for 15 years. Like if my 500 family and friends that I told about didn't buy this, like they weren't my family and friends anymore. And I think we lucked out too, because it was such a stupid idea. It's like the Snuggie blanket that it's like 95% of people told us Boxer Pockets was so dumb, but 5% were like, that's hilarious. I'm buying it right now. So it had a visceral reaction. It wasn't just like another underwear company. So I think that helped a lot for initial purchase. And then it being a giftable product helped too, because people didn't just buy 1 pair, they bought 3. So really like the first 1,000, we only really needed like 300 people to buy. But I easily could have gotten to that point without quitting my job, but I also think stuff kind of worked out because I did it.
All right, guys. Thank you so much. Let's give a huge thanks to Fraser and Jack.